Where you purchase the vehicle or how you purchase the vehicle is irrelevant. Everything comes down to the usage. So if you're using the auto 20% for business, then you only get to deduct 20%. And whether you buy it personally or through your business, for tax purposes doesn't matter. Now, if you're building business credit, obviously you want to get things purchased under the business to, build business credit. But everything as far as your deduction comes down to how much you use the vehicle. What's the purpose of the vehicle? There's two methods for deducting autos. One is the actual expense method and one is the standard deduction. To do actual, you actually have to use the vehicle 50% or more in the course of business. If you do, then you can make the election to use actual expenses. Then you get a percentage of all the gas, all the insurance, the maintenance, and also you get to depreciate the cost of the vehicle. Now, if you only use it 70%, then you get 70% of all those deductions. And in addition, you can take a percentage of the interest charges if the vehicle is financed. And any parking and tolls is also allowable. Now, under the other method, which is standard deduction, the IRS sets a rate, usually per year, but some years have had two different rates depending on what fuel prices are doing. And then you get to take that rate times the mileage. In addition, on that method, you get to take a percentage of the interest and then any parking or tolls. On average, or if you look over the course of several years, the method you use, it usually will come pretty close. It's usually a timing. When you do actual, a lot of times you get a bigger deduction initially because you're getting that upfront cost of the vehicle purchase. With standard mileage rate, you're going to get a more consistent deduction, but you're going to get that deduction consistently year after year, where actual, the deduction will taper off in later years because you'll run out of depreciation. The IRS is very picky about the mileage log. In all reality, if they go by IRS code, they can disallow 100% of your deduction if you do not maintain an accurate mileage log. The mileage log should have the date, the location you went to, the reason you went to that location, the beginning and ending mileage for the day, and the total miles that trip took. Without that, the IRS could disallow the deduction because you didn't keep adequate records. When you go through an audit, one of the biggest things that will lose an audit or give you unfavorable outcome of an audit is not maintaining accurate records. So that, mileage logs are very critical regardless of which method you use because both methods are, the bottom line is derived from the mileage log.